and gentlemen, after a brutal sell-off in the markets last week, and for REITs, you have seen one of the worst sell-off. But is it time now to get back into the market? Now, in our last 33 years of history, GCP Global is well known for calling market bottoms. Now, in today's video, I'm going to share with you 4 particular characteristics that we need to identify in order to call a market bottom, which indicates it's time for you to get back into the market for REITs. Now, essentially, ladies and gentlemen, these 4 characteristics have been time-tested, back-tested, forward-tested as well in our experiences for the last 33 years in teaching. For REITs, is the last 20 years. And so far, our accuracy is in the region of 80 to 85%. Now, so in today's video, we're going to share with you how and to what extent are we able to call it correctly and therefore help you to multiply your portfolio. Ladies and gentlemen, how to know when to start buying back your REITs? Now, essentially, this is the topic of our video today. We're going to cover 2 characteristics, and the other 2 characteristics we're going to cover next week. So it's a continuation. Please log on and join us again next week. Now, once again, this is the characteristics, and these are the common traits which I've actually highlighted in my book, Making Your Millions in REITs, which you can purchase from all bookstores in Singapore, Malaysia, Southeast Asia. The Chinese version, which is published in China, in the US, you can also buy it online. Now, ladies and gentlemen, the first characteristics that stood us by where we have predicted correctly in the last 33 years of teaching has been number 1. When the rise in interest rates have nearly discounted the full Federal Reserve move. Okay, now let's look therefore at the key metric here. This is the 10-year bond yield. So, ladies and gentlemen, what are we looking for, in the 10-year bond yield? Okay, so let's move on. So what we look for, ladies and gentlemen, is the Singapore 10-year bond yield. Okay, as you can see, ladies and gentlemen, since the lows reached in the middle of 20 post the pandemic low, we were doing at 0.6% thereabouts. Okay, even up to the end of last year, we were doing at 0.66%. And suddenly, in the course, of 2021 started to move up, pull back, move up, pull back. You can see the turbulence were coming in. So for those who've been attending our classes since last year, you notice that we have forewarned you on this. We have told you to lighten on your REITs portfolio, and guess what? We have been right, and the correction has set in, and the correction has been brutal since last week. So therefore, having survived that, what do we do now? Do we look for this sign to tell us the same sign that actually help us to exit, stay on the sidelines, to enter the back into the market, or what? Okay, what did the signal actually say? Since the end of last year, you notice that the 10-year bond yield in Singapore has shot up. Doesn't mean that the very sharp rise from 0.81% as of last year to 2.77% this year, that means in a space of 5 months, is sufficient to actually curb or fully discount the Federal Reserve increase in interest rates. As you know, ladies and gentlemen, they are likely to go up to about 3% end of this year and maybe 4.25% next year. So is this sudden rise, sudden sharp up? You notice that markets do not just come down in big spurts. There will be opportunities for you to get back in. So is this indicator flashing green for you, therefore, to be taking in or getting your feet wet in this instance? Okay, this is what we will cover in detail in our class, our next class, which is the physical class on the 13th of August. Now, this is the details here, ladies and gentlemen. So for those of you who are interested to sign up, this is the website to go to at GCP Global. I know it's actually quite far away, 3 months away, but yes, ladies and gentlemen, at GCP Global, we have been teaching quarterly or REITs classes for the last 33 years, and we only teach once every 3 months. So do sign up quickly. It's a physical class before the tickets are being sold out. It'll be held at PLQ3 at C Suites, in courtesy of the Landlease Group. Now, let's move on, therefore. What is the second factor then? Okay, the second factor, which has been something that we've been trumping in all our write-ups. As you can see, if you look at GCP Global website, we have been telling you that distribution yield. Important thing, ladies and gentlemen, is that when dividend yields have risen above 6% again, then it's time for you to get back into REITs again. But then again, you know, is 6% sufficient, or do you need 6.2% or 6.5%? Okay, now let's delve into deeper. Okay, so ladies and gentlemen, now with the delisting of ARA Logistics because of the successful merger with ESR, you can see that now there are 39 REITs. Okay, so I'm going to show you in the next 3 tables the performance or the yield of the 39 REITs that we have traded in the S-REIT market. You can see that essentially, most of them are given over here, the likes of Capital Mall into the Starhill Global. And guess what, ladies and gentlemen, if you look at one of this was Capital DC. You notice that Capital DC, ladies and gentlemen, the yield has now risen to 4.3%. Now, in our classes, ladies and gentlemen, at GCP Global, we have warned when Capital DC yield fell below 3%. You know, at that time, it coincided with the share price raising to $3. You know, and now the sell-off has actually brought the share price down to 194 as of the lows last week. So is it time, therefore, to get back into Capital DC? Have the correction sufficiently discounted all the pessimism on Capital DC? So, ladies and gentlemen, let's look further. You know, you can see that this is the chart for Capital DC. You can see that in the course of just 1 year, that means from the high of February last year at 3.03, the share price has fallen or collapsed down to 195 of Capital DC. Now, for those of you all who have actually been following us, you notice that we do weekly videos on YouTube. You can look at my last weekly video on Capital DC, for which we have shared with you why did Capital DC crash badly. But for those of you who have joined us for our investment classes, you notice that we have warned you in the last 1 year, right? And Capital DC has actually suffered a whopping loss of 1.08. You know, more than $1 loss, yes, ladies and gentlemen, or a loss of 36% when it fell from 3.03 at the high in February last year down to 1.95 just last week. Now, in the history of S-REITs, other than during COVID-19, that was actually between March and February of 2020, as well as the global financial crisis of 2008 and 2009, you don't have a REIT. In fact, Capital DC is the first REIT that suffered such a huge loss of 36%, despite showing a year-on-year increase in DPU. So therefore, ladies and gentlemen, do you smell something, you know, that was fishy on Capital DC, but now it's turning delicious, right? This is something that we discussed in detail in our class, because you know why? We will be presenting with you some of the key metrics other than just dividend yield. The other metrics that we watch very closely as highlighted in both of my books, okay? But in our class, we go through for you, okay, a live true example, and this is what we'll do for Capital DC. We do at GCP Global, ladies and gentlemen, we don't just analyze facts, okay, and changing developments, okay, independently. In fact, what we do is that we consult and meet with the key officials of the respective REITs themselves to verify, double check our facts before we come into a conclusion. As you can see, ladies and gentlemen, just last week we had lunch with the lovely Miss Antia Lee, who is the CEO of Capital DC, and Miss Lillian Goh, who is the head of corporate communications at the Capital Group. Okay, so in the lunch, basically, we were able to verify a few assumptions on the legal case pertaining to the DMX lease dispute. We were able to encapsulate, for example, the new contributions from their various assets they acquired last year. Is it sufficient to help them turn around the share price? Of course, these things are detailed analysis, Therefore, we only reserve to discuss this in detail in our class on 13th of August. So do sign up if you actually are thinking of having more capital DC to add to your portfolio or to average down, and to see our views on capital DC. Okay, as now is at 5.902% as of today. But ladies and gentlemen, as I questioned earlier, okay, do REITs dividend yield have to cross above 6% for REITs to be performing again? Or does that therefore indicate a time for you to be jumping back into REITs again? This is what we'll discuss in our class, as well as you can see that, oh my goodness, look at Parkway Live REIT, okay? The yield has fallen down below 3%. Hang on, 9.02%. Okay, so as you look down the list, you can see most of them have risen because the share price has fallen. But wait a minute, you can see that, oh my goodness, look at Parkway Live REIT. Okay, hang on. Didn't I say that, when with our experience on Capital REIT, we actually caught the sell on Capital REIT at $3, Capital DC REIT at $3 last year because the dividend yield went below 3%. Are we seeing the same thing happening for Parkway Live? Right, because it's the first time since its listing in 2007 that the yield has fallen below 3%. Okay, now that's because it's been one of our favorite REITs for all these years. In fact, in my book, ladies and gentlemen, Parkway Live gets a great preview of why it has been able to outperform for the last decade, why it will continue to outperform. But hang on, okay, there is a price for anything that is too good, as what we said for Capital DC, right? So for Capital DC, we actually told you to sell off at 3. Now below 2, we are already sourcing for you whether it's time to get back in below $2 after a 36% huge correction. But it's the same thing going to happen, okay? And you can see the share price went from 130 when we actually recommended in our classes, right up to $5, so it went to 520 in our previous classes in February as well as November last year. We already forewarned that if it's above 5, it is already $5. It's a good price to be taking profits because it has shot up from $1.30 to $5 in 5 years. It's been a whopping almost 300% return in just 5 years. Hardly any REITs have been able to exhibit such a powerful outperformance in such a short period of time over 5 years as what Parkway Live has done. So what are the fundamentals? What are the technicals we're looking for to actually warrant basically taking profit in Parkway Live? Okay, this is again what we will discuss in our classes. Now, so ladies and gentlemen, as you can see, we basically are always looking forward, right? In my article for the Business Times, I've said that as REITs have survived COVID-19, but what lies ahead? Okay, so we have actually forewarned students, investors in our classes that it was time to be backing off since last year on REITs because we're waiting for major correction. And true enough, 5 months later, we were proven correct. It's a huge correction, it's a brutal sell-off last week, but is it time to get back to REITs? Okay, so the last slide, ladies and gentlemen. Now, this is the details of our class. If you feel that you want to learn in greater detail and join us for our class, on 13th of August. Yes, it's 3 months away, but do actually sign up to enjoy the early bird special. Do actually contact us if you want the early bird special code so that you can actually sign up for your classes at below the full price, because of limited seating. So do join us again, and hope you enjoyed today's video. Now, remember, we covered 2 of the 4 criteria that we use in our classes to analyze when to get back into REITs after a major correction, right? The next week video, do like us and subscribe to our video program so that you will be notified on our continuance of this week's video into next week. So once again, have a great week ahead, and do smell when the blood is on the street, and because the only way to make big money is to be able to have the courage to buy, but more importantly, not only just the courage to buy, the courage must be backed up by the key fundamentals and the key turning points. And this is what we discuss in detail and teach you in our GCB Global REIT investment process. So